Welcome, dear friends and investors. I hope all of you had a great and safe Diwali and New Year. And here's again wishing you all a very, very happy Diwali and a New Year. And I hope the next year turns out to be very, very good. As you know, while India had a fantastic Diwali and people were out on the streets, people were out traveling, consumption trends have been very strong. But the big question that most investors have is from here, where? And we continue to see the news flow coming from outside of India, which continues to be very, very challenging. We still have inflation which is persistent, as a result of which we are seeing that central banks around the world continue to raise interest rates. We've seen a 75 basis point hike by the Fed and a 75 basis point hike by the UK central bank. And obviously, that is likely to slow down the economies of US and Europe. We don't know how deep and how long this slowdown is likely to be, but clearly there are worries on that count as well. The war is still not conclusively over, and energy prices continue to be very high. China growth has imploded, and geopolitical tensions continue to remain. So, with all of this gloom and not so great news around the world, obviously investors are asking a question: will India hold back its resilience as well as it has done so far? And yes, indeed, the Indian markets have been very resilient. And we've talked about this in our previous communication that earnings have been good. And as I said last month in the run up to the festive season, that as the economy opens up, we've seen a rebound in consumption, and that is likely to continue to hold the growth pretty strong in India. And there are a lot of things that have gone India's way. India did not bust up its fiscal during the COVID period by handing out free money. We have a post-lockdown recovery in demand, a very strong festive season. We have bank balance sheets which are now completely clean, which means that they can start to lend. And a lot of the reforms that we did over the last few years, like GST, the PLI reforms, the launch of the 5G, which is giving confidence to the economy. However, the question still remains that how long can you live with the strength in consumption that we are seeing currently because of the opening up and after 2 years people having the freedom to travel and spend. And therefore, this month, we looked at what are some long-term structural factors that will sustain India's growth momentum. And the most important factor there is whether companies, businesses, and the government is spending on capital expenditure to increase capacity. And when we looked at the data, it is quite heartening. The investment cycle has kicked off in India. And if you look at the gross fixed capital formation, or GFCF as they call it, we are seeing a clear trend upwards. So what is GFCF? GFCF is nothing but the net addition of fixed assets by businesses, whether it's the PSUs, whether it's the private sector, whether it's the household sector. And when do people invest? People tend to invest in capacity when they feel confident about the future, right? And if you look at the trend, India's gross fixed capital formation, which was at 27.5% of GDP in 2019, has risen to almost 31% in March 22. And therefore, the trend is very, very heartening. What has also enabled this? If you look at the corporate balance sheets of corporate India, we have seen that they have generated phenomenal cash flows and they have deleveraged their balance sheets, which means that corporates do not have the debt burden that they used to have 5-10 years ago. And again, if you look at the data, you will see that net debt to equity has fallen from almost 0.68 of net worth to 0.41, and the lowest, it is trending towards the lowest that we saw during 2011 when it was 0.36. So corporate balance sheets are much lighter, they don't carry too much debt, and therefore corporates can start to invest again. They can lever or they can use their existing cash flows to build up capacities. The other major advantage or competitiveness which is required to restart the capital cycle is tax rates. And there, if you look, India now today for manufacturing companies has a very, very competitive tax rates. India's tax rate for manufacturing companies is only 17% and is equal to Singapore and China and much lower than many of our Asian competitors like Indonesia, Malaysia, where tax rates are relatively higher than what they are in India. So we now have very competitive tax rates. We are starting to see capacity utilization move up, which means that existing capacities of companies are now almost getting to 75-80% levels. Usually that is an inflection point when companies start to think about adding new capacity so that they can take advantage of the growth in the future. And if you look at that data of capacity utilization, which the RBI gives out, we have seen that it dropped very significantly during COVID, but now it has rebounded to pre-COVID levels and even higher. So if you look at all the factors that drive capacity utilization, lower debt levels in corporate balance sheets, very competitive tax rates, and improving capacity utilization. On top of that, we have seen a plethora of reforms. I will not get into the details, but we've talked about this, whether it is labor reforms, whether it is reforms in Atmanirbhar Bharat and PLI to encourage manufacturing, whether it is taxation reforms or reforms in the banking sector in terms of IBC and so on and so forth. So we now believe that there are the right environmental factors which should trigger a very strong capex cycle. And are we seeing an evidence of that? Yes. If you look at the data on new investments announced by various companies and projects announced, we are again seeing a very, very solid trend. After many, many years, in FY22, new projects announced both in the public as well as the private sector has scaled to 16 lakh crores. And this is much higher than what we've seen in the last 5 years. And the growth has really picked up. During the first quarter was 4.3 lakh crores. Just in the 2 months of July and August this year, it is 4.4 lakh crores. And therefore, I think that by the time we end this year, you will see a significant pickup in announcement of new corporate capex. And where is this coming from? If you look at the distribution within the sectors, largely you will see that there is a big rebound in manufacturing. As you all know, friends, we've been talking about that we had a lost decade of manufacturing in India between 2010 and 2020. And now as we get into the new economic cycle, I think the next 5 to 10 years will be fantastic for manufacturing sector in India. We are also seeing new capex coming in the service sector. So hotels, tourism, all these companies are now starting to spend again. When we go down to the micro level and look at the companies in the capital goods sector, in the manufacturing sector, we are seeing order books starting to fill up, right? Whether it is defense, whether it is energy, whether it is renewable energy, whether it is 5G, we are seeing that the order backlogs of companies are growing very, very rapidly. And therefore, we believe that there is hard evidence to suggest that the pickup in the economy that we've seen as a result of the opening up of the economy and consumption coming up is not just led by consumption and credit growth, but is also led by a very, very long-term cycle of capital investment. So I think India is entering into a phase where businesses are having the confidence to start to invest again. And that's why we have been so confident that the recovery and the resilience that we are seeing in the Indian economy and the Indian markets is far more sustainable and is based on long-term factors rather than just short-term factors like the rebound in consumption. And therefore, we believe that we continue to be bullish on India. Yes, the news flow around the world is very challenging. And I think that if you look at the last 1 year, the markets have been literally flat, while most global markets have corrected anywhere from 15 to 25% or even more. We believe that as some of these clouds around the world get resolved over the next couple of quarters, I think India continues to be an island of stability and growth, and therefore we believe that Indian markets will continue to outperform global markets even in the long run. With that, I bid adieu until we talk to you next month. Thank you. Bye-bye.